there's going to be a rethought, or investors are going to rethink what is risk-free. And once that comes forward, you're going to see a massive flow of capital into gold and silver. That the ratio where it stands right now at 90-1 it's insane. And I mean, it allows anyone to just off the cuff say silver is the least expensive asset on the planet. And it does have a characteristic of money, and it does have the characteristic that it cannot bankrupt, it cannot default. And the world is in an era right now of bankruptcies, defaults, insolvencies. This, I've said all along, it's going to be a credit event.
The national debt reached a staggering $34 trillion by the end of December, as reported by the Treasury Department, sparking a heated debate between GOP and Democratic lawmakers grappling with federal funding issues. This financial backdrop sets the stage for potential economic shifts and policy responses. Amid the escalating national debt crisis, currently hovering at $33 and $34 trillion, concerns are raised about its impact. Analysts like Bill anticipate a pivotal event that could force the Federal Reserve into action, particularly the lowering of interest rates. While acknowledging the likelihood of short-term rate adjustments, Bill does not foresee a substantial decrease in interest rates over the medium to long term, spanning 5, 10, or 30 years. Instead, he envisions a scenario where the yield curve steepens, especially if the Fed opts for significant rate reductions to 2%, 1.5%, or even 1%. Even the 2011 downgrade of U.S. debt by rating agencies indicates changing perceptions about the risk associated with U.S. Treasuries. Bill Holter considers the traditional notion that U.S. Treasuries are the sole risk-free paper assets globally outdated. He anticipates a profound shift in capital allocation as investors reassess their understanding of risk-free assets. In response to ongoing market dynamics, gold and silver prices remain relatively steady in midday U.S. trading. The economic data, including a GDP report indicating steady growth, contributes to overall stability. Bill envisions a significant capital flow into gold and silver as investors consider these metals reliable alternatives. The silver market experiences a notable uptick, reaching nearly $23, following the People's Bank of China's announcement of a liquidity booster to stimulate post-pandemic economic recovery. Bill underscores the unprecedented gold-to-silver ratio, currently at 90:1, shedding light on the undervaluation of silver. This observation suggests the potential for a transformative shift in market perceptions regarding the intrinsic value of silver, further fueling its appeal as an attractive asset on a global scale. We will present clips from Bill Holter's interview with Arcadia Economics, but before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
$34 trillion in debt, that's only going to go up. And I do believe we're going to see some type of event that's going to actually force the Fed's hand into lowering rates. But if you take a view of a year from now or 2 years from now, I don't think but I don't think interest rates are going to be a lot lower than they are right now. They may be on the short end, but not out 5 years, 10 years, 30 years. I think the yield curve is going to extremely steepen, especially if the Fed knocks rates down to 2% or 1.5% or 1%. What's not been taken account of, well, for many, many years, even before the 2008, 2009 train wreck, what's not been taken into account and what's not been thought about is the risk premium on U.S. paper. U.S. paper has always been considered risk-free. And I think we're going into the zone now where foreigners are looking at, and especially foreign central banks, I think, are looking at U.S. Treasuries and saying, hey, wait a minute, there actually is some risk. And I guess the very first inkling of that was back in 2011, when either Standard & Poor's or Moody's downgraded U.S. debt. But that's been a thought process since World War II, is that the U.S. Treasuries are the only risk-free paper assets on the planet, and they're not risk-free. And I do think that in this zone or time period, at some point in time, there's going to be a mass flow into gold because gold cannot bankrupt. It cannot, and silver also. They cannot bankrupt. They cannot default. Whereas it's the math is plain to see that the U.S. mathematically is going to default either by non-payment or having to blow the money supply up another, twofold, fivefold, tenfold. They're going to destroy the currency itself. So I do think that there's going to be a rethought, or investors are going to rethink what is risk-free. And once that comes forward, you're going to see a massive flow of capital into gold and silver. And we've had, like you said, 2 big deficit years. And obviously, worldwide, they're pushing this green plan, and they've not thought it through as to where the supply of these metals are going to come from. As far as what's left or how much is left, I have no idea as far as what or where the metal has come from. But all I could say is if you're burning 200, 300, 400 million ounces per year, you're pretty soon at a billion. Like in a year, there's within 12 months or 18 months, we'll have burned through a billion ounces of above ground supply. How much was there? I don't know what the number is, but I do know that the ratio where it stands right now at 90-1 it's insane. And I mean, it allows anyone to just off the cuff say silver is the least expensive asset on the planet.
The silver market is currently subject to manipulation and suppression by banks, creating an environment where exposure of this manipulation, coupled with a collapse of the monetary system, could trigger a surge in demand and price for silver. Bill attributes this suppression to utilizing leveraged contracts in credit and stock markets. He predicts that when credit becomes scarce and existing credit diminishes, the artificial support for stock and real estate markets will crumble during a credit event. This, in turn, creates a scenario where gold and silver prices experience an upswing driven by their intrinsic physical value. The anticipated reset gains further clarity when Bill underscores that the forces suppressing the markets will no longer be sustainable as credit evaporates. This absence of credit support becomes the catalyst for a significant reset. As Bill explains, the reset is a direct outcome of credit and derivatives losing their efficacy in enabling authorities to manipulate asset prices according to their preferred narratives. In essence, removing credit as a manipulative tool allows assets to reevaluate and establish their values in alignment with market dynamics. Let's get back to the interview.
There's not a checkpoint with central banks, and the reason being they can print more money. So they never have a problem of, this month's paycheck didn't cover my bills. They don't have that problem because they can print. Now, banks themselves do have that problem. And obviously, entities in the real economy have that problem. If their income doesn't match their outflow or match, just look at a piece of real estate. So you buy a $500,000 piece of real estate, you put $100,000 down, you borrow $400,000. You wake up one day and your property's only worth $250,000. You have negative net worth, and if you or your wife or whatever happen to lose your job, now you have a problem servicing it. You can't print money to service your debt. So what do you have to do? You're gonna have to sell, and you walk away with nothing. And that's the reality of where the central banks are right now. If they liquidated their portfolios, they would have a negative net worth. Gold and silver have been suppressed with paper contracts not backed by physical gold. The credit markets, the stock markets, they've been levitated with leveraged contracts. And when the credit event blows up and credit becomes impossible to obtain, and credit, the credit that's already outstanding starts to go away, the prop underneath the stock markets, the prop underneath the real estate markets, those are going to go away. You're going to see asset prices collapse. And at the same time, you're going to have a run into gold and silver from a physical standpoint. But more importantly, the price mechanism or the suppression that's been allowed by the use of credit, that's going to go away. It goes back to like putting a beach ball underwater. Once the credit evaporates and you can't hold it underwater, it's going to shoot, sky high while everything else is collapsing. So, I mean, there's the beginning of your Mother Nature reset right there.
Yeah,
Once credit and derivatives no longer allow the powers that be to price assets according to what they want to provide cover for their narratives, which their narratives, all you got to look at them, they're bullshit. I mean, they flat out say 2 + 2 is 5, and then they try to prove it to you with market activity. And that market activity is forced by derivatives, backed by credit.
Precious metals like gold and silver, held in tangible forms such as bars or coins, will continue to be recognized as genuine money and reliable stores of value. These assets stand apart due to their freedom from counterparty risks, as gold cannot go bankrupt, default, or be artificially created. How do you envision these dynamics shaping the future landscape of economic and investment scenarios? Share your thoughts in the comment section below. If you find this video informative, remember to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.